Welcome to the deep dive. Today we're really jumping into, well, a classic battleground stock.
Mm-hmm.
We're talking about a small drone company caught right in the middle of, future warfare tech and this whole tangle of legal issues and, frankly, immense risk.
Yeah, it's a big question, isn't it? Is this a chance to get in on something huge, dominating the skies, or is it more of a cautionary tale?
Exactly.
Hmm.
We're going to unpack a company where everything seems to hang on delivering these really audacious promises while also dealing with some, well, pretty serious allegations against the people in charge.
And here on the deep dive, that's what we do. We take your sources, could be reports, research, even your own notes, and we pull out the crucial insights.
The goal is to give you that shortcut to being genuinely well-informed. We try to bring you those surprising facts, help you connect the dots. It's all custom-tailored for you.
Today, it's a comprehensive depth dive into RCAT Holdings, Inc. The NASDAQ ticker is RCAT.
Right, RCAT. And just so everyone's on the same page, all our analysis is anchored to July 24, 2025. The stock closed at 8.98 cents per share then.
And our mission for this deep dive is to give you a balanced, neutral understanding of RCAT. We'll look at the core business, the leadership, the financials.
The wider market, the
Yeah.
risks. Basically, everything you need to see both the potential opportunities and the very real headwinds they're facing.
Okay, let's get into it.
Right. Let's start by really understanding what RCAT Holdings actually does.
Chapter 1, business analysis. So fundamentally, RCAT is it's a pure play bet on drones. That's their thing.
Pure play, okay.
Yeah, they design, develop, and integrate robotic hardware and software, specifically drones and specifically for military and government use.
So not consumer stuff anymore.
Well, that's the key point. They operate through two main subsidiaries, Teal Drones and FlightWave Aerospace, they call it, their family of systems. But the really interesting thing is the strategic pivot they've made.
Right.
A very clear, decisive move away from the consumer market to become essentially a new defense contractor. They're chasing those high-margin, high-stakes defense contracts.
Gotcha. So defense focus. What are the key products then? Is there like a main one, a crown jewel?
Definitely. Teal Drones makes the Black Widow. That's generally seen as their flagship product.
Black Widow.
It's a small unmanned system for ISR. That's intelligence, surveillance, and reconnaissance. And the huge thing here, the monumental milestone, was the Black Widow being picked as the sole winner of the U.S. Army's Short-Range Reconnaissance Program, the SRR contract.
Sole winner. That sounds significant.
Oh, it instantly boosted their status, their credibility. Hugely important. Then you have FlightWave Aerospace with the Edge 130 Blue. That's a military-grade VTOL drone.
VTL, so vertical takeoff and landing. More flexibility.
Exactly. Plus other things like Femmer for precision strike and Tricon for longer endurance missions.
Okay, interesting hardware. But it's not just about the drones themselves, is it? I think I read something about a big partnership. Does that make them different?
That is absolutely crucial. They have a strategic partnership with Palantir Technologies.
Palantir, right.
Right.
Big name in defense tech.
Huge. And this isn't just, sticking some software on. It's deep integration of Palantir's advanced AI, their visual navigation software, VNav, and even their warp speed manufacturing system into RCAT's platforms.
So what does that do for them?
Well, think about it. It transforms their drones from just flying cameras into, intelligent nodes in a much bigger network. They feed data directly into the wider defense intelligence system. That makes them incredibly sticky for the Department of Defense.
Sticky, meaning harder to replace.
Exactly. It's a real differentiator beyond just the drone specs.
So tying it back, their market position really hinges on that Army SRR contract being the sole provider there. What gives them that edge? Why them?
It really comes down to being U.S.-made, secure, NDAA compliant, and having technologically advanced systems.
NDA compliant, that's the National Defense Authorization Act, basically banning certain foreign tech, right?
Precisely. Especially giants like China's DJI, who are largely shut out of the U.S. defense market due to national security concerns. So, RCAT fills that gap. They also push their dominate the night capability with thermal imaging, and use a modular open systems approach, MOSA, for easier upgrades.
Okay, so they fit a specific need created by regulation and technology demands. And the market itself must be booming for this stuff.
Oh, absolutely. They're riding a super cycle of growth. The global military drone market, it was about $36 billion in 2023, projected to hit, wait for it, $88 billion by 2030.
Wow, that's huge growth.
It's a compound annual growth rate of nearly 14%. And it's driven by tech advancements, AI, flying without GPS, lessons learned from conflicts like Ukraine, and importantly, aggressive U.S. policy to bring drone manufacturing back on shore.
The government is actively helping companies like RCAT then.
Very much so. They're creating a protected space.
So who are they actually competing against within that protected U.S. space? It can't be a totally free market.
No, you're right. It's heavily shaped by politics and regulations. Direct U.S. competitors. You've got Skydio. There have been some reports about their drones maybe underperforming in Ukraine, especially at night, which is where RCAT claims strength.
Interesting.
Then there's AeroVironment, a more established player. But like we said, DJI, the big global commercial leader, is pretty much out of the picture for U.S. government and defense work.
And the regulations themselves, are they mostly helping RCAT?
Yeah, significant tailwinds. There was that June 2025 executive order unleashing American drone dominance, pushing for U.S.-made drones. The latest NDAA puts up more barriers for foreign drones and supports American makers. Plus, the FAA is working on rules for beyond visual line of sight, BVLOS flights.
BVLOS. That could open up huge commercial markets down the line, right?
Potentially massive, yeah, long-term opportunity there.
So getting into this market sounds tough. You need security clearances, fancy tech, the ability to actually make lots of drones.
For sure. Barriers are formidable. You need things like Blue UAS certification. That's the Pentagon's approved list. Serious R&D. And yes, scaling manufacturing to meet military demand is a huge hurdle. That's actually a key point of controversy for RCAT right now.
We'll get to that. So their unique advantages are that SRR contract, the Palantir link, being U.S.-made and NDAA compliant.
Yeah.
But what about costs? Are they cheaper?
Well, that's the kicker. Right now, they have no cost advantages, zero. In fact, their financial statements show deeply negative gross margins. Meaning it costs them more to build a drone than they sell it for.
Ouch.
Yeah. Economies of scale are definitely a hope for the future, not something they have now.
That does sound precarious.
Yeah.
Okay, let's shift focus now to the leadership. Who's steering this ship?
Chapter 2, Management Evaluation.
Okay, the CEO is Jeffrey M. Thompson. You said he's a serial tech entrepreneur. Does he have the right background for this specific specialized industry, aerospace and defense manufacturing?
Well, that's a point of discussion. He's got tech startup experience, yes, but his direct background in specialized A&D manufacturing is, let's say, limited. And then, of course, you have the elephant in the room.
The lawsuits.
The class action lawsuits against management that popped up mid-2025. They came right after a pretty critical report from a short-selling firm, Kerrisdale Capital.
Right, Kerrisdale.
Yeah.
What are the suits actually alleging?
They're alleging materially false and misleading statements by management, which, really hits at their transparency and ethical reputation. Critical stuff for a defense contractor.
Can you give specifics? What did they allegedly mislead about?
Yeah, the allegations claim, for instance, that management publicly talked about production capacity of thousands of drones per month.
Thousands.
Right. While the reality, according to the allegations, was closer to maybe 100 per month. There are also claims they sort of jumped the gun, preemptively announcing the SRR contract win without getting the Army's okay first.
That directly challenges their credibility, doesn't it?
Absolutely. Especially when you're dealing with military contracts, trust is paramount.
Okay, so with these legal clouds hanging over them, how are they actually using their money?
Yep.
Capital allocation. Are they pushing forward aggressively or being cautious?
Definitely aggressive growth. They're pouring significant capital into scaling up manufacturing, retooling their Salt Lake City facility, building a new, bigger place for the Edge 130 drone.
Makes sense if they expect big orders.
Right. And M&A, mergers and acquisitions, has been key too. They bought FlightWave Aerospace, which brought in the Edge 130 and that Blue UAS certification. Also, Skypersonic for tech that works without GPS.
And how are they paying for all this? It sounds expensive.
Primarily by issuing new stock. That's the main funding source. For example, they did a $46.75 million registered direct offering back in June 2025, sold over 6.4 million new shares.
Which is dilutive, right? It waters down the value for existing shareholders.
Exactly. Each existing share becomes a smaller slice of the pie. Investors are essentially betting that the future growth funded by this dilution will make their smaller slice worth much, much more eventually. But it's a trade-off.
So, given they're spending all this money and, as you said, losing money on each drone sold right now, what does their return on invested capital, the ROIC, look like, I'm guessing? Not good.
You'd guess right. ROIC is deeply and consistently negative. We're talking numbers like minus 60% to minus 143% on a trailing 12-month basis.
Wow. So short term, they're actually destroying value with the capital they invest.
Based on current operations, yes. The entire investment case rests on a massive future turnaround in ROIC once, or if those large-scale contracts kick in and they finally achieve economies of scale.
And dividends or buybacks?
Nope, none. Which is totally normal for a company in this high-growth pre-profitability stage. All cash is going back into trying to grow the business.
Okay, let's dig deeper into those numbers now, the actual financials.
Chapter 3, Financial Analysis.
All right, let's talk numbers. Market cap, around $889 million as of late July 2025, so definitely small cap territory.
Yep, small cap. And revenue growth has been explosive, but from a tiny base, like $0.4 million in fiscal 2020 up to nearly $18 million in fiscal 2024.
That sounds impressive on the surface.
It does, but recent data shows a potential slowdown, or at least some lumpiness. Trailing 12-month revenue is actually lower than the full fiscal 2024 figure, around $16.5 million. And one recent quarterly report showed a really steep year-over-year decline, like 72%.
72% decline. How do they explain that?
Management puts it down to a pause in manufacturing. They say they had to stop or slow down production to retool their facilities specifically for that big SRR Army contract.
Okay, so that makes this period absolutely critical then. Is the decline temporary due to retooling or something else?
Exactly. This is a pivot point. The whole investment thesis banks on a dramatic reversal of these recent trends, with huge revenue coming from the SRR contract driving economies of scale.
And those profit margins you mentioned,
yeah,
just how bad are they?
They're deeply negative across the board. Trailing 12-month gross margin is about 11%, but the most recent quarterly gross margin was a staggering negative 52%.
Minus 52% gross margin. So they spent way more making the drones than they got selling them that quarter.
Correct. And operating and net margins are even worse. We're talking negative hundreds of percent. It's a major, major red flag about their current operational efficiency.
That level of loss must mean they're burning through cash like crazy. Is free cash flow consistently negative?
You got it. Consistently negative free cash flow, just heavy cash consumption. Over the last 12 months, they burned through about $42.3 million just from operations.
And that's why they keep having to sell more stock and dilute shareholders.
That's the cycle, yes. They need the cash to keep the lights on and invest in growth. And right now, the capital markets are the main source.
So financial stability sounds pretty shaky. What does the balance sheet look like?
It's definitely fragile. Earnings are consistently substantially negative, and the losses have actually widened quite a bit since 2020. Their debt-to-equity ratio shot up significantly, now around 96%. And the current ratio, which measures short-term liquidity, it's tight, like 1.02, meaning current assets just barely cover current liabilities.
So that $46 million capital raise they did recently was essential.
Absolutely essential. It shored up the balance sheet and gave them desperately needed working capital. Without it, things would look even more precarious.
Okay, so huge growth potential maybe, but terrible current financials, negative margins, cash burn, dilution. How on earth do you value a company like this?
Yeah, it's tricky. Traditional metrics like price to earnings, PE, are useless because earnings are negative.
Right.
If you look at price to sales, PS, using the trailing 12-month sales number, the ratio is incredibly high, like 53.4.
53 compared to peers.
Way higher than most industry peers. It tells you the market is pricing in an absolutely massive amount of future growth. It expects a huge, almost immediate revenue surge from that SRR contract.
Okay, so the market price reflects extreme optimism. We also ran an educational discounted cash flow model, a DCF. What did that suggest? Keeping in mind it requires making big assumptions.
Right, big assumptions. Our educational DCF assumed pretty aggressive revenue growth, getting to maybe $120 million in 2025, over $150 million in 2026.
Which would be a huge leap from the current $16 million TTM.
Massive leap. And we assume they eventually reach a net profit margin of 12.5%, kind of like mature defense tech firms.
Yeah.
Based on those optimistic inputs, the model generated an estimated intrinsic value range of $7.50 to $11.50 per share.
Okay, $7 to $11.50, and the stock price was $8.98 when we anchored this. So right in the middle of that range.
Exactly. But the crucial thing to emphasize is how highly sensitive that valuation range is to those very aggressive assumptions. If they miss those growth or profitability targets,
the valuation could drop significantly.
Precisely. It's all about future execution.
Okay, we've looked inside the company business management financials. But how is RCAT viewed from the outside? What's the market sentiment and what are the big risks? We'll tackle that right after this short break on the deep dive. Welcome back to the deep dive. We've covered Red Cat's internals. Now let's look outwards. Market perception, ownership, and the crucial risks.
Chapter 4, Market Sentiment.
So how does Wall Street generally feel about RCAT analysts? Are they buying the story?
Overwhelmingly, yes. Wall Street analysts are decidedly bullish. The consensus rating is a buy.
Okay. Any price targets?
Yeah, the average one-year price target is around $13.60. The range goes from about $12 up to nearly $16. So analysts see potential upside of anywhere from, 35% to 75% from the current price?
So they're clearly focused on the future potential, the SRR contract.
Seems that way. They're buying into that growth narrative, despite the current financials and risks.
Which is interesting because you also hear a lot of negativity, right? That whole battleground stock thing. The media tone seems really divided.
Absolutely polarized. You've got the bullish story, the huge SRR win, the Palantir link, the favorable geopolitical climate pushing U.S. drones.
Right.
And then you have the bearish story dominated by those class action lawsuits we talked about,
Right.
and that really damaging short seller report from Carisdale Capital. This division is exactly why the stock is so volatile.
Speaking of bears and volatility, what about short interest or a lot of people betting against the stock?
An exceptionally high number. Short interest is huge, about 15.9 million shares held short.
Wow. What percentage of the float is that?
It's somewhere between, say, 18.7% and 20.2% of the company's freely traded shares. That's a very large group of investors betting heavily that the price will fall.
But doesn't high short interest also create another dynamic? The short squeeze potential.
Exactly. That's the other side of the coin. With so many shorts, any significant positive news could force them to buy back shares quickly to cover their positions, which can cause a rapid, sharp price spike. It makes the stock, as you said before, a real powder keg.
Volatile indeed. Despite all that, where does the actual share price sit relative to its recent trends, its moving averages?
As of late July 2025, that $8.98 share price was actually trading above both its 50-day and 200-day simple moving averages.
Okay, so the shorter term and longer term price trends were technically positive at that point.
Generally, yes. It suggests some positive momentum recently and a generally upward long-term trajectory, even with all the bumps along the way.
Interesting. Okay, let's shift to who actually owns Red Cat shares.
Chapter 5. Ownership structure. Institutional ownership, meaning big funds, pension funds, etc. It's relatively low, somewhere between 18% and 22%.
That seems low for a company with this kind of potential story.
It is quite low. It includes passive index funds like Vanguard and State Street, who have to own it as part of an index. Among active managers, the sentiment seems really divided. Some have been adding to their positions, but others, including big names like Susquehanna and BlackRock, have significantly reduced their stakes recently.
Okay, so mixed signals from the big money managers. What about the insiders? The management, the board, are they buying or selling?
Now this is where it gets quite concerning from a signaling perspective. Insiders still hold a decent chunk, maybe 13.6% to 18.2%, and the CEO, Jeffrey Thompson, is the biggest single insider holder. However, there's been a really concerning pattern of significant and consistent insider selling over the last 12 months.
So, like, how much?
We're talking over 3.5 million shares sold by insiders compared to only about 575,000 shares purchased.
Wow, it's a big difference.
It is. And you saw notable sales by directors in May and June 2025, and by the CEO himself back in December 2024. This kind of consistent selling across multiple insiders, it's a classic bearish signal.
And it kind of lends weight to the concerns raised by that short seller report and the lawsuits, doesn't it? If management isn't holding on tight.
It certainly raises questions and contrasts sharply with the public bullish narrative and those analyst price targets.
So if institutional ownership is low and insiders are mostly selling, who is holding the majority of the stock?
Ownership is pretty spread out, or diffuse. But the largest group holding the shares is actually retail investors, individual investors like you and me.
Over 68% retail ownership.
Yeah, over 68%. And that high retail component definitely contributes to the stock's volatility. Retail investors can sometimes be more reactive to news and sentiment shifts.
Okay, that ownership picture is fascinating and maybe a bit worrying with the insider selling. Let's move to the overall risk assessment.
Chapter 6, Risk Assessment.
Let's try a SWOT analysis approach. Strengths, weaknesses, opportunities, threats. What are Red Cat's core strengths?
The number one strength, without a doubt, is that sole source U.S. Army SRR contract. It's foundational. Tied to that is their status as a U.S.-based NDAA compliant provider.
Right, the regulatory moat.
Exactly. Plus the strategic tech partnership with Palantir and their specific tech focus on things like night operations and GPS-denied flying, which are critical military needs.
Okay, strength's clear. What about the weaknesses? Where are they most vulnerable?
Well, we've hit on these. Fundamental unprofitability and severe cash burn. Those deeply negative margins are a huge weakness right now.
Okay.
Then there's significant manufacturing and execution risk. Can they actually scale up production effectively and efficiently? That's a massive question mark, especially with the legal and reputational issues swirling around from the lawsuits and the Kerrisdale report. And finally, the fragile balance sheet with tight liquidity.
Right. Big weaknesses. What about opportunities? What could propel them forward?
The biggest opportunity is simply the market they're in. The biggest one is probably extreme customer concentration. Right now, they're overwhelmingly reliant on that one big customer, the U.S. Army.
If anything happens with that SRR contract.
It would be devastating. There's also intense competition from other U.S.-based drone companies fighting for the same contracts. Technology moves fast, so obsolescence is always a threat. And, political winds can shift. A change in policy could remove some of those favorable regulations.
Makes sense. How do bigger economic factors play in, like inflation or interest rates?
Well, inflation could definitely squeeze those already negative margins even further, making things more expensive. And higher interest rates make borrowing money more costly, which could constrain their growth plans, especially since they rely on outside capital.
And those U.S. tariffs on Chinese drones, you mentioned them as part of the opportunity.
Yeah, it's kind of paradoxical. Those steep tariffs, reportedly 170% on Chinese drones in April 2025, and the talk of a potential outright ban on DJI by the end of 2025, that's actually a huge benefit for RCAT.
It clears the field for them.
It creates that government-enforced competitive moat we talked about. The main threat related to this would be if that protectionist trade policy suddenly got reversed.
Okay, fascinating dynamics. Let's try to pull all these threads together now.
Chapter 7, Conclusion.
So, RCAT Holdings. As we said at the start, it really is the definition of a battleground stock.
Okay.
Let's summarize the bull case first. Why might someone be optimistic?
The bull case is basically right place, right time. You've got strong geopolitical tailwinds, the U.S. government actively supporting a domestic drone industry. That SRR contract is the golden ticket, provides revenue credibility. They have a tech edge from Palantir and a focus on critical military needs. And they're tapping into a massive, fast-growing market.
Okay, that's the positive story. Now, the bear case. Why the skepticism and negativity?
The bear case centers on a significant crisis of credibility. Those serious allegations in the class action lawsuits about misleading statements on production and contracts are a major issue. Then there's paramount execution risk. Can they actually deliver on scaling up for a huge military contract, especially given their history of lumpy growth, widening losses, and burning through cash?
And the insider selling.
And that very concerning pattern of consistent insider selling, which just doesn't align with a bullish outlook. Plus, fragile financials that mean they need continued access to capital markets, likely meaning more dilution.
So weighing all that, what's the valuation summary again?
Based on our educational DCF model, which, remember, relies on very aggressive future assumptions about growth and profitability, the estimated intrinsic value range came out between $7.50 and $11.50 per share.
And the stock, as of our anchor date, July 24th, 2025, was at $8.98, right in that range.
Right in the range. But again, that valuation absolutely depends on them successfully executing a future business plan that is, frankly, far from certain right now. It's a high-stakes proposition.
Definitely sounds like high risk, high reward. The whole investment case seems to boil down to whether management can actually deliver on these huge promises and somehow put those credibility issues behind them.
Absolutely. The next few quarters are going to be incredibly revealing. We'll see if they can ramp up production, generate revenue from the SRR, and start improving those margins. It's make or break time.
So a final thought for you, our listener. As RCAT Holdings tries to dominate the night for the U.S. military, what do you think will ultimately decide their fate? Is it the powerful tailwinds pushing them forward, or the internal storm of execution challenges and those legal battles?
Something to ponder.
Indeed. If you found this deep dive valuable, please do remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
And for just $4.99 a month, members get priority deep dives on specific tickers you request. We're planning to cover all the S&P 500 stocks over the next few months, and members get that exclusive priority access.
Or if you do want a one-off deep dive on a particular company, you can always drop us super thanks. We appreciate the support.
And finally, the important reminder. This analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice.
Please always do your own thorough research or talk to a qualified financial advisor before making any investment decisions.